We have moves to document, more of them. Jenny, you sold B&G Foods. That stock's down 37% year to date.
Another one of my worst losers.
Why hasn't this worked?
I don't know. And I think that's part of the problem is I really don't know. 2 quarters ago, it looked like they were back on track. It looked like they'd managed the portfolio well, and it looked like they were returning to $1 of earnings. Then this quarter, it's like all off the table with no good reason, with no way to say this is why it hasn't worked. So at that point, I'm just like, all right, I have no investment thesis left. Somehow, by the way, neither them nor Kohl's have cut the dividend. They're both sticking with that, but I'm out. And again, I need the losses. We have huge realized gains this year, so we just got out.
You got out of Conagra, too.
No, I added Conagra.
Oh, I'm sorry, you bought Conagra. It. My bad. My bad. I read that wrong.
You know what's interesting about that? The last time I was on, when we were talking about this, and you and Steve and I were saying, when we were reading the room, we're seeing chaos. What happened was, with the RFK nomination to HHS, we saw all the consumer staples stocks just tank like 8 and 10%. And I've been working on Conagra all year. So this is the most drama-free, plain vanilla stock that I think and hope I'll buy in the next year. Conagra makes food, a lot of frozen food. It's, I think, a healthier portfolio than, say, a Smucker's or a Pepsi or a Hershey. And so you've got a company with a 5% dividend yield, trading at about 9-10 times earnings, 3 to 4% earnings growth ahead. They expect the dividend to grow about 3% on top of that. And I think the multiple is too low. So if you just had earnings growth plus the dividend, I think you get 8-9% growth in the years ahead. If there's a little bit of multiple expansion where they get back to historical averages for the group, maybe you have a 11, 12, 13 times multiple, and you get a nice bump on top of that. But I think this is a really good place to hide out in a drama-free spot in a world that may be chaotic coming up on us.
You bought Honda.
Yeah.
You used to own Toyota, which you sold in the spring.
Right.
Why you buy Honda now?
Honda is such a cool story. So this is for our international income strategy, and I'll go quick on this. 5.5% dividend yield. 50% of the market cap of the company is sitting in cash on the balance sheet. That's crazy. So they're buying back shares, but they could, if they wanted to, just fund the dividend for the next 10 years. Meanwhile, their main areas are automobiles and motorcycles. In motorcycles, they've got 35% global market share. I think one of the thoughts there is like, oh, tariffs. Well, they have a huge factory in Ohio, a huge factory in Alabama, so things are produced locally. They get out of the tariffs that way. Yes, there's some in Ontario. Motorcycles are produced locally, so there's not tariff issues. And they've got really nice growth. Oh, sorry. And one other thing is, as interest rates come down, that drives motorcycle growth. So it's just a terrific company that's really safe right now.
Okay, thank you for that. Jason Snipe, you're selling Intuit.
Yeah, sold it. The momentum's obviously not there. It's been a very weak year for the stocks, only up 4% year this year. Last year was obviously a great year. Doge is considering a lot a things.
Well, right? Show it over the last, I don't know, what does a 1 month look like?
Yep.
Because minute or even a week or so, this was, I mean, some of the tax filing reforms that are being talked about, that's what you're alluding to.
Yes.
Out of D.C. hit this stock pretty hard the day that news came out.
100%. And to your point, obviously Doge is considering a free tax filing app, which obviously would run right into TurboTax, which is their play. So who knows if that will happen or not? It's, in my opinion, it's unlikely. They had to address it in the earnings call, which makes sense. But for me, they missed on the guide. They beat on the top and the bottom in the last quarter. Software has obviously run a ton over the last 6 months. It's up 37%. They have not participated in a meaningful way. So that's why we decided to move on and look at other.
Yeah, there's kind of like a 1 month there. It gives you an idea of what was up, and then, went through that little valley there. Weiss, you're trimming GXO.
Yeah. So it pains me to do that because I still like the story, but it's going to be dead money. So the stock took a hit. First, the stock was lifted when there were rumors published by Bloomberg and Reuters that they were up for sale and being approached by buyers. The story came out the same day. The story came out that they were not. The sales process ended. And the CEO, Malcolm Wilson, who I've gotten to know fairly well, was retiring. So both took the stock down more than 10%. I sold not quite at the lows, but I also had some puts that partially hedged the position when they announced the potential sale. Bloomberg, that is, GXO never did. So at this point, it's dead money. I don't know who the new CEO is going to be, of course. They've retained search firm for it. Additionally, growth has to pick up. And it's a highly competitive space. And if you take a look at FedEx, for example, they just signed a deal with Nimble Robotics that fully automates the warehouse. No people. And that's going to be their partner in the business. So you have to spend a lot of money on technology at this point.
Don't you have GXO? Or you did, didn't you?
Yep,
you do now.
We still do. Mm-hmm. It's in the growth portfolio.
You just called it dead money.
Okay,
you just sat by as if you didn't say anything.
So here's where we are in GXO. The investment thesis on GXO for us is that if you look at the multiple versus Old Dominion, it trades at like half the multiple. So I disagree on dead money, but it's predicated on needing multiple expansion. It's not super compelling.
Okay.